The Federal Reserve's a much highly anticipated FOMC gathering. It was held the last 2 days. They broke it up today and they decided, you know what, let's keep rates right where they are. Some of the things they talked about, of course, were business conditions, that bad jobs number. They admitted that global events, particularly the UK situation, is also looking interesting. But Janet Yellen not convincing Wall Street. The market rallied and then it sold off. What exactly is going on? I brought in two of the best, David Nelson and Shah, Gilani, to help us hash it all out. Guys, forget about the market reaction. I always say it's the next day to see how once the market digests the news. It wasn't news per se. We knew they weren't going to hike rates, but we wanted to get that Q&A session. What do you make of the whole thing?
Well, the Fed meetings and the discussions and the policy rhetoric are increasingly non-events. But what's happening really, and investors are starting to catch on to this, is that everything that the Federal Reserve has done, this is true of the rest of the central banks around the world, hasn't worked to stimulate any economy. And what's happening now is the wealth effect, the pumping up, the bubbling up of assets and asset prices is what they're trying to support. So interest rate policy now globally is about supporting the markets so they don't crash and we don't end up in a deep, dark hole.
But markets not crashing doesn't help economies. So ultimately, I don't understand the end game, David.
I don't know if the Federal Reserve has no impact at all. Certainly the market is watching what's going on. Nobody expected anything in June because of a potential vote at the end of the month regarding
and that 38,000 jobs number also.
And that really hit it, and that really caught investors off guard. But to his point, the emperor appears to have no clothes right now, and they just can't seem to get the job done. We've had low interest rates for a really long time. It's unintended consequences. That really what disturbs me. It changes corporate behavior. CEOs take the early way out, and they're buying back stock with issuing cheap debt. That comes at the expense of R&D, CapEx, and a whole lot of other things. And today, former Fed Governor Richard Fisher said he's very concerned about insurance companies, money markets, and community banks. That's pretty disturbing.
Well, German 10-year bond going negative, $10 trillion in global, sovereign debt yielding negative. All the traditional red flags have been raised, and they're glaring at us. But you wonder because they don't have the wherewithal to get out of this. Should they sort of take a page, the old Paul Volcker thing, hey, we're going to hike rates, it's going to be painful.
They can't, Charles.
I disagree.
They're stuck. They're stuck because what the Federal Reserve is doing now, what the central banks around the world are doing now, they're supporting markets. They have failed at supporting economies. They have not mustered any economic growth of any meaningful.
But they're not getting thing out of property.
Right. This is what policy.
There's no virtuous cycle. There's no wealth effect. That hasn't kicked in.
The wealth effect is the pumping up of markets, and that is.
But it hasn't extended to people going out and making investments and spending money and things like that.
And that's what's so scary. Of America, you start hurting insurance companies. This is how people, make their life.
So do they have the guts or the wherewithal to say, okay, we're going to start hiking rates. We don't care if Wall Street collapses.
Look, we understand that the normalization process, that it's going to be a lower interest rate. We're not going back to 6%. Maybe we can budge up to 3%. But right now, this is unintended consequences. They have to slowly move higher and get out of this ridiculous game that everyone's playing.
Interest rates would be low. They'd be on the floor anyway if the Fed didn't do anything, especially if they didn't do any quantitative easing, which is really all about saving and pumping up the balance sheets of the banks. Nothing would have happened. Interest rates would be low. Right. So artificially low, and especially in Europe and in Japan, into negative territory is a testament to what hasn't worked.
Right. And, of course, buying all this junk, this toxic junk from banks.
It's ridiculous.
Thinking that maybe once the banks didn't have to worry about that, they would do something.
Well, early on, I thought that was a good idea.
It seemed like it on paper. Also, we do have to come to the Fed's defense in one sense. That's just monetary policy. They're not in control of fiscal policy.
And that's what's really not happened here. We haven't passed the baton.
All right.